Options. They're used all around the world across a variety of assets. Many of you probably have even tried your hand at trading options. However, the mechanism behind how options are priced is often mysterious to investors. Most people in finance have heard of Black Scholes and might have even built the model once or twice. But have you ever stopped to wonder what the individual components mean and how they work together to determine the output, and what kind of assumptions were built into the model to arrive at the conclusion? In today's video, we're going to be answering just those questions by taking this now famous financial model and breaking it down so that we can understand the finer details of the Black Scholes formula. As a warning, there will be a bit of math in today's video, but don't worry, we'll be breaking it down and discussing the arithmetic in detail. Also, there will be an Excel file linked to today's description with a breakdown of the topics discussed in the video, which will help you better understand the concepts at work and assist you in building your own options model. So let's dive in. We're going to assume that you have a basic understanding of options. You know that options are linked to an associated asset called the underlying. You also know that all options have a strike price, an expiration, and can be bought long or sold short. You should also understand the concepts which differentiate calls and puts. So let's begin. The Black Scholes formula was first articulated by Fisher Black and Myron Scholes in a paper titled The Pricing of Options and Corporate Liabilities, a link to which can be found in the description if you're interested. To begin, we'll focus on the value of a call option. Then we'll simplify it to an easier to understand formula, breaking down the components at play, then reincorporating the simplified components to build a full understanding. Once we understand the call option formula, we will use our knowledge to easily derive a formula for puts, and then prove out our put formula using our financial knowledge. The formula for a call option is as follows, where D1 equals and D2 equals. If we plug D1 and D2 into our first equation, we get this, which is a rather cumbersome equation, but if we break it down, it becomes much more conceptually simple. Let's assign each of the variables a name so we better understand what they represent. C is the price of our option. This is what we're solving for. S is our underlying's current price. For example, today we will be assuming the underlying is a stock, but in reality an underlying can be any asset. T is our time component and is assumed to be in years unless otherwise noted, where T equals 1 is equal to 1 year. Sigma is our underlying's volatility. This is an annualized number unless otherwise noted. R is our annualized risk-free rate and is used for discounting. E is Euler's number and is like pi in that it represents a fixed number. Euler's number is equal to approximately 2.71828 and is a constant used for continuous discounting. N is a function for a normal continuous distribution. We will get to this later to discuss what this function means. Ln is the log normal function. And K is our option strike price. With this information, you can easily take all the variables, put them into a calculator, and get an answer for C. However, what we're interested in today's video is not so much what the answer to C is, but how all these pieces come together to compute C. In other words, what is going on inside the formula. In math, when applicable, it is often useful to simplify a form into smaller structures when analyzing it. Cutting the form into smaller bite-sized chunks will let us do that. First, let's simplify D2. Doing some algebra, we find that our initial D2 value is actually equal to this, which looks very similar to our D1 value. We can work our way through the various algebraic steps to prove this relationship. Now that we've simplified the D2 value, let's assume that our option expires in 1 year, so that T is set to 1. Additionally, we will be assuming that we're living in a zero interest rate world where money today is equal to money tomorrow, so we will set our R to 0. If we do this, we find that our equation simplifies significantly. This is a much less complicated equation, and we can now consider this simpler equation in order to gain an understanding of what's going on. First, let's break down the ND1 value. The first thing we should look at is the log of S over K. What is this component and what is it saying? Also, why are we taking the log of these two values? Simply stated, S over K is the ratio of our stock price to our strike price. We are taking the log of this ratio to normalize the relationship with respect to 0. When the price of the stock is less than the strike price, the call option is out of the money, and the sign of our ratio is negative. When the price of the stock is greater than the strike, the call option is in the money, and the ratio is positive. This dynamic will be the driving force behind our ND1 relationship, but it is not the entire picture. Now let's assume volatility is very small, virtually 0. When S equals K, or the call option is at the money, then we see that as sigma approaches 0, the value of our D1 value is 0. Now, if we adjust S and K under these assumptions, then we see that as S becomes larger than K, the equation quickly tends towards positive infinity. While as K becomes larger than S, the equation quickly tends towards negative infinity. So let's use this understanding to help build out what in D1 is doing. What is the in function, and what does it mean? The in function is a stand-in for the cumulative normal distribution at our value of D1. The cumulative normal distribution is given as this integral. We will not be diving into the nuance of the integral and why pi is a part of it. However, 3b1b has already made a fantastic video covering this exact topic, and we highly recommend you check it out if you're more interested in learning about normal distributions and why this is the equation for it. What is important to know is that for a normal distribution, a value of D1 corresponding to 0 is equal to 0.5 or 50% of the normal distribution. If we consider a normal distribution curve, what this means is that at a value of 0, we are at the exact mean of the distribution, whereby 50% or 0.5 of our values under the curve fall at this point or less. So, in the case of our limit, we see that when S equals K, or when the call is at the money and volatility approaches 0, our value of in D1 is 0.5. What we're gauging here is how sensitive our option is in relation to changes in the underlying stock's price. This is often called delta by option traders and is one of the first order Greeks. The Greeks are important concepts, and we will be covering them further in future videos. Expanding upon our knowledge of ND1, we see that the function is still subject to the sigma variable, which is our stock's volatility. To better understand the impact volatility has on our ND1 value, let's consider what happens when volatility moves away from 0 to a more realistic number like 0.2 or 20% annualized volatility. Keeping S equal to K, we can see that our ND1 value has increased to about 54%, meaning that for every $1 change in stock price up or down, the value of our options price will change by 54 cents up or down. This is very useful for traders looking to hedge their positions, as it determines the number of options needed to hedge the underlying asset. As volatility increases, so does the sensitivity of our stock. If volatility were to become, say, 300%, or sigma equals 3, we see our ND1 value, which we will from now on refer to as delta, becomes 93%, meaning a $1 shift in the stock price will change the value of the call option by 93 cents. This is logical, because the stock is now riskier, and this risk is reflected in the options price sensitivity, making the option riskier. Now we understand our equation for delta, which we did by simplifying some variables. But what about if we add in a new variable, t? What does this do to our delta value? Simply put, if we keep all things equal, a larger t causes our delta value to become larger, and a smaller t causes our delta value to become smaller. Why is this the case? Theoretically, if we have more time to wait, a larger t, then there is more risk in the option, giving more things can happen between now and maturity. In other words, the impact of our volatility is heightened. But what happens as t becomes very small? Let's consider a new scenario. An option is set to expire 1 second in the future, and you quickly pause time. Now, you can analyze the option at your leisure. When examining the option's delta, you see that one of either two things has occurred. Either the option is in the money, where the stock price is higher than the strike price, or the option is out of the money, where the stock price is lower than the strike price. In the money case, we will see the delta is of 100%, meaning that the option has essentially become valued in lockstep with the price of the stock. In the out of the money case, the option delta will be 0%, meaning that the option is worthless, given there isn't enough time remaining for the option to enter into moneyness. This makes t a very powerful variable, especially at the end of the option's life, when any changes in S, K, or even the volatility have little to no impact on the delta values as t begins to approach expiration at time 0. At expiration, the option is either in the money or out of the money, as there's no time remaining to change the ultimate outcome. This inevitability is reflected in the delta value, with the inclusion of the time variable. Now we understand D1, but what about the rest of the formula? From here, the understanding becomes easier to explain, as the fundamentals have already been flushed out. Let's now break out our Black Scholes into two pieces. The left hand of the equation is much of what we've already discussed. Given a stock price S, what is the relative payout of the stock price against delta? We can think of S in D1 as our payoff component, or reward portion of the Black Scholes equation. Then what is K times ND2? This is our cost portion of the function, or what we're giving up by owning the option. D2 is similar to D1, but has an inverse relationship to volatility and represents the option sensitivity to our strike price K. As volatility increases, the sensitivity of the option strike decreases, all else equal. An interesting aspect of options is the relationship between ND1 and ND2. Many new options traders often learn that delta, ND1, can be used as a proxy to determine the odds that an option will finish in the money. Based on your understanding so far, do you believe this is true? If you're close to expiration, then delta is more accurate in determining the estimated probability of finishing in the money. But what if we were at the money with 90% volatility and 5 years until expiration? Would you believe me if I said the option had an 87% chance of finishing in the money? Probably not. 90% volatility is a lot, and 5 years is a while to wait. The stock price could go anywhere in that time. So what is a good way of estimating the probability of the option expiring in the money? The answer is to take the average of the ND1 and ND2 values. By taking the average, you are balancing the return and cost factors to establish the likely expected probability. As a rule of thumb, at zero interest rates, regardless of volatility or time, at-the-money options will have a 50% ND1, ND2 average. This is because the distribution profile in a standard Black Scholes model is assumed to be normal. Remember, the 50% probability may or may not reflect economic reality, and you need to conduct your own analysis to understand if the model is appropriate for your scenario. All models are wrong, but some models are useful. The normal distribution assumption is often pointed to by critics as one of the major drawbacks of the Black Scholes model, as asset returns rarely reflect a normal distribution. So now that we understand the two components of our model, we can put them together to find our call options price. Lastly, let's examine why we're discounting K, the strike price, by the interest rate with respect to time. Why do we discount the strike price value and not the stock price? Consider that we're looking at two prices, one which exists in time now, the stock price, and one which exists only in the future, the strike price. In finance, we have to pay special attention to prices with respect to where they live in time. The strike price is not reflective of a price now. It is reflective of some price in the future, which must be discounted back to its present value today. But what about put options? This answer is simple. Using our knowledge of put options, we know that a put option is the inverse of a call option. Logically, our formula should look something like this. That was easy, but do we believe this? Is there a way we can prove this formula is correct? Well, we could run through our previous example with calls to determine the dynamics with respect to puts, but let's do a fun and easy proof to conceptually understand the dynamics of put pricing. In the option space, there's a concept known as put-call parity. This idea states that the value of the put should be offset against the value of the call with respect to the discounted strike and stock prices. Why is this so? If we were to take on a long call and a short put, both at the money, the payout structure of this position should look identical to a stock, less the discount of the strike. The position is discounted as this is seen as the cost of money to have entered the position, as compared to a stock which is paid in cash, allowing for no arbitrage between the actual stock and the synthetic put-call position. The put-call parity is shown as the following. If we were to assume that all our options were at-the-money options, then we could set this parity to equal 0 while setting all S equal to K, which we'll denote further as X. To solve, we can set the equation equal to 0, and we can show that the two sides of our equation are in fact equal. There's a bit of algebra involved, but if you work your way through it, you should be able to prove that calls and puts exist in an arbitrage-free parity. That was a fair amount of math, and we recommend you take a look at the attached Excel sheet, which demonstrates many of the concepts detailed in this video. If you want to see more content like this, then be sure to like and subscribe. Now, please enjoy one of these quality videos on finance recommended just for you. Have a great day.